Hello, you're watching Dukascopy TV. Now joining me in the studio today is Eva Zaki, who is a financial advisor and blogger here in Geneva. Eva, thank you for coming into the studio.
Hello Thomas, thank you for inviting me.
Now today we're looking at central banks, but we're looking at some of the relevant stories to have perhaps affected central bank movements and could potentially affect central bank movements in the future. Noticeably, you'll see by this background, Ukraine has been in the news a lot recently. And of course, we've got Syria, and there are a number of other regions in the UK at the moment that could be affecting the stability when it comes to risk in the markets. As geopolitical risks, such as those in Ukraine and Syria, and risk appetite declines, do you think enough pressure could be exerted on central banks like the Federal Reserve, resulting in a change, in the Federal Reserve's case, a change in their timetable to their bond buying programme? Yes,
I think so. For example, looking at what happened this weekend, there was a meeting between Secretary of State John Kerry and PM Sergei Lavrov of Russia, and it hasn't yielded much results, so the diplomatic standoff continues. So obviously this story is not over, and the uncertainty remains in the market and it's felt. But what could happen to the US economy is that we've seen that the prices of commodities and assets have risen dramatically while wages have stagnated. And we're talking about an economy that's 70% consumption driven. And the consumers' disposable income hasn't been really supported. There's been little fiscal support to the Fed's policy. The credit hasn't been available to those who would spend it. So asset prices are left vulnerable to market perception when it becomes obvious they're overvalued. If we're realistic, the Fed-induced bull market is fragile as long as we don't have a fully fledged recovery. So geopolitical risk, yes, could place an additional burden on stimulus withdrawal and deflationary risk.
2 weeks ago, Janet Yellen suggested rates would start rising 6 months after the end of QE. Are markets right to expect the first hike by mid-2015, do you think?
I doubt that very much. We've seen there's been a bout of volatility in the market. Recently in March, biotech stocks tumbled 7%. Investors were having doubts about the fundamentals of the recovery and the real nature of the winter slowdown. Next week is the kickoff of the earnings season, and we'll see that large US companies have indeed suffered from the weather, but it's by far not the sole factor. The most realistic prediction about the Fed hiking rates, I think, is that of the Kansas City Fed chair, that, I quote, the rates may be hiked a considerable time after the bond buying ends and based on a wide range of factors besides unemployment and inflation. So that sounds more like what we've seen so far. We've seen that there has been no rate hike in the last 7 years since December 2006, and we've seen an uninterrupted sequence of QEs since QE1 started in November 2008 through QE4. So I say, why don't we say hello to QE5?
Just quickly, briefly, if we could, Eva, we've got a couple of graphs here on the background as well. We've got the S&P 500 here. It's sort of reflected in what you were saying there, wasn't it?
Yes, you can see how volatile the market has been, and this has not been usual for the S&P in the last years. We've seen that there have been big stability, a continued rally, and everyone saw the bullish trend would continue. Oil reflects the fact that there's been a disruption in supply, and that the tensions between Russia and the West are fostering worries. Also, gold is now losing momentum because obviously, while other commodities are supported, the risk appetite for gold is lower, while we think that the recovery is on its way, but with doubts. And well, the assets that are most supported now are still stocks, obviously.
Let's look at just a final question. The president of Bundesbank, Jens Weidmann, had declared that he no longer excludes balance sheet expansion by the ECB. That's been changed now. He's sort of withdrawn his comment, has he?
It looks like he took back what he said during the weekend. So on Saturday he said, yes, the Eurozone inflation rate, it was out two hours ago, and we've seen it at its lowest level since 2009. It's 0.5%. So he said, yes, it's very low, but it's not deflationary. It's only temporary, and the ECB should not overreact, should not rush to cut rates. But obviously everyone else in the market would expect the ECB to do something about this deflationary risk. And we also see that many people think the euro is now very high and it should be weaker compared to other currencies to support recovery. So obviously the market is expecting the ECB to become more dovish in coming.
More dovish, and we can see actually here again from the graph, it's there. It was peaking up there. We had one above 1.39.
Yes, and the level is still high, although at this point, with market dovish expectation, the euro should go lower, obviously.
And then finally the euro Swiss franc here as well, Eva.
Yes, although the Swiss franc was very strong recently, the euro has still maintained its level, and it's been expected that now, obviously, the Swiss National Bank will have more hard work in order to maintain this peg.
So once again, we'll have to keep an eye on the Fed again and on the ECB with regards to those potential movements and the geopolitical sphere. Thank you, Eva, once again for coming into the studio.
Thank you very much, Thomas.
That's all for the moment here on Dukascopy TV. We'll join you for the next interview, though, later today. But for now, bye-bye.